To wrap things up in international pricing, we need to look at the nitty-gritty of all the final things, like how do we handle pricing within our own companies? How do we deal with payments when we got to work with different suppliers in different markets? And what's available out there for you in terms of exchange risk and strategies against that? So ultimately, when we're looking at this is about how do we get our money back? How do we get our money from our suppliers and out of our foreign markets into our own pockets and into dividends for our stockholders? So that's what we're looking at in this, and you have to be careful with the law and the mechanisms. Transfer pricing, we're worried a lot about selling, but not a lot is talked about in terms of how we sell within our own companies. There are a lot of rules here, and you cannot just say, I sell pens to my company so I could just remunerate money back in my market. You can get in trouble for that because, we're worried. Companies sell to each other all the time within their subsidiaries. And if you have a 20% stake or more in a company, you have to follow, they're considered a subsidiary, and you have to follow strict transfer pricing rules. What is transfer pricing? Transfer pricing is the prices used on goods sold between related parties, whether it's from a division to a division in a company or a parent company to a subsidiary. There has to be a relation. That relation, like I said, is typically whether you have a market share ownership of a company that's 20% or more, it's considered a subsidiary, or maybe two divisions in an auto factory are working together to sell each other parts to finish a product, or it's even joint ventures or cartels and other coordinated sells. You have to start following transfer pricing rules. Transfer pricing rules are regulated. Overall, it's to why do we sell to each other? We want to optimize corporate profits rather than just divisional profits. The price should be low enough to enable the international division to be competitive. So we could sell to each other at a price that's competitive. I didn't buy computer chips or ceramics to help make my cars. Buy a company and buy those at a price that others are paying. I would like to pay at a price that's competitive for my acquisition, but high enough that I'm not, that the other division's profitable and fair. So you have to do very carefully here. Transfer pricing and tax regulations. Different market corporate taxes influence these prices. So, for example, taxes in the United States is at 20% or so, right, for the corporate tax, and it's like 12% in Ireland. Obviously, if I'm selling between two divisions, I can keep profits in the lower taxable market and not have to pay the taxes in the United States as one mechanism. Government authorities are always looking to get their money back. Uncle Sam wants their money, so they're going to find out ways. So what developed is a model convention. It's called the Transfer Pricing OECD Model Convention. There are several model conventions for OECD. This one is regarding to transfer pricing. There's also about taxes. The model convention worries about the transfer price at which an enterprise transfers, sells physical goods, intangible property like software, or provides services to an associated enterprise. The example looks like this. Company A and Company B, goods for 100 euros, but they're associated to each other. They know each other because they have a tied relationship, financially, legally, some sorts. The OECD created this treaty, this convention, which is a treaty that could be allows government authorities in bilateral agreements with each other to regulate transfer pricing. So those that signed on to this or have their own are able to have regulatory guidelines. So your company has to follow them. If you say this, you sell 100 euros worth of pens, but you sell it to company B for $10,000, you have violated a transfer price agreement. There is an international treaty, most likely, that you are in violation of, and you have to correct that or get fined or whatever. So the OECD guideline was started in '95 as an attempt to provide worldwide consensus on intra-firm transactions around the world. One of the biggest mechanisms in the model convention, is the belief that prices should be based on the arm's length principle. Everything within my arm's length is within reach, so that's where the price has to be. You cannot go beyond that. So 100 euros of pens, and I sell it in other countries for 150 euros, I can be within that range and be considered acceptable. $10,000, for example, is not acceptable. Arm's length principle is that belief of the arm reach. Just keep that in mind. So the commercial and financial relations have to comply. So if there is a relationship, you have to do a profit adjustment. The determination of transfer prices are at the arm's length. So the profit adjustment is based on how it's sold, how you sell it to others, how it's sold on the market in general, or what is considered the cost of the item, and then the profit gross profit in the industry. There's different ways to measure it. Don't get hung up on it, but just know when you're selling a product between other firms that you have a relationship with, like subsidiaries, you have to follow specific guidelines that are treaties. So, hope that helps. That's something that a lot of people don't cover. I find it a very fascinating topic. Another thing you have to worry about now is, how do we get money back from people, that we're buying and selling from? If you do consignment sales, for example, I'm giving you a bunch of Coca-Colas for your store, and then you pay me what you sell, and I'll just take back what's not sold. You have to trust that they're selling the right price, or that they've sold the right numbers. And also, you have to know that the product actually will sell, because Coca-Cola has a shelf life. You don't want to have spoiled products that you never made money off of. So, that's just one idea. So you want to balance the need of the seller versus the buyer. And culture plays a factor, but in negotiations, this is then called the meeting of the minds. We have to be on the same page of what we think will work for both of us. If I have a long-term relationship with somebody, I have a lot of trust with them, and they want to come back and buy from me, then I can flex those options. We could do what is called an open account, which is a net 30 or 60 or 90 days where the buyer has to give payment back, and usually the exporter can extend the credit to the buyer so they can do that. So there are programs for you in the United States to sell abroad. So, for example, we have payment method insurances. We have ways to back up exports so that we can help make sure you get those sales out there. Or for importing, so you have importing protections as an American business. So there's a lot out there. Check out trade.gov. There's no reason that you can't get some kind of backing or partnership to protect you in your payment method. Another method of, as I mentioned earlier, is consignment, where the transaction is based on the sale of the goods, and then you're waiting for them to remunerate you later. That's dangerous. What if they run and steal your stuff? I would not do that with luxury items, for example. Cash in advance is the typical payment method, most common, partially because you're paying in advance for the sale of goods. And so you have to be careful at most common. It's like you tell the buyer, you have to pay me first for me to give you the goods. But you have to be careful. One of the reasons why Amazon struggled in China, for example, is they struggled with the payment methods. Consumers didn't want to pay you for you then to ship me goods. I don't trust you. I don't know who you are. Who's this merchant that you said is going to sell to me? It defeats the old way of doing pay and get right away type ways. So to get around that as a business to business, we do what is called a letter of credit. By the way, sidetrack, consumers' protections are through their credit cards for fraud. That's pretty much what we're left with. But in business to business, we could do letters of credit, which allows a business to sell and then get a credit from a bank that holds the money and protects the buyer from getting their money. So when the product is sent or you receive money, you receive the product, they receive the product, you get remunerated right away and by the bank. They don't care whether the product's insured or if it makes it or how it makes it. That's not their problem. They're not involved.